In this video, I'm going to talk about dividend income, how to achieve monthly passive dividend income, and also how much you'll need to retire and live off of dividends, and of course, how my portfolio has performed this week versus that of the market. So let's jump right in. Gosh, my hair right now looks like Justin Bieber when he was like 13, and that's not a look I want to have. I really need a haircut. This week, similar to last, we've seen considerable rallies in the markets. I think the FTSE 350 is up about 6.8%, which includes both the FTSE 100 and the FTSE 250. And truth be told, I have no idea why it's increasing. I get the feeling that there's currently a lot of fear in the markets and investors are worrying that they might miss out, so they're buying now. Or perhaps long-term investors are seeing such huge value at the moment anyway that they're just buying in because they think in 5-10 years time these stocks are going to be worth so much more, so why not buy now, which is also a fair reason to have. And currently, the economy is not doing good, and it's retracting at an alarming rate. We're seeing high unemployment figures and also loss in GDP growth, and in fact, retractions of it. Although we should really applaud the furlough scheme because it has done well and held up well. It's meant that less people have been laid off and they've continued to be paid. Although, yes, it's done well for the time being, but what happens when they go back to work? These places that typically people have been furloughed from, you can only have half capacity now. Are they really still going to need that many workers? So I get the feeling that people will still get laid off, but at least they were paid something, right? What is important to know is that the economy is not the stock market. And yes, there are times whilst they will do similar things. You might see a growth in the economy and a following subsequent growth in the stock market. But you should realise that they do go down different routes. Currently, the stock market is looking at the futures and it's quite optimistic. It's looking down the road and how big businesses will perform. Whereas the economy is more or less looking at how we're doing currently, and we're retracting. But people see in the next few months that we will start to grow, or at least get back to the level we were at. And in fact, the economy does take into account the smaller businesses too. And that's where the stock market doesn't really include them, because if you're listed on the stock market, you're at least a considerably sized business and some importance to the economy. But it does also seem that investors have priced in potential outcomes, but then at the same time, it feels like they've kind of neglected the point of Brexit. I thought that, personally, in my experience, that Brexit compounding with the fact of a pandemic crisis and the oil price war, which I believe to be over now, I did think that this would lead to a lower price in the market, but in fact it's quite different, and people are looking quite optimistic about the market and buying in at considerable rates. I personally am not too bothered about the capital appreciation of my portfolio. Yes, it is currently up 1,000, and today our current portfolio total is 6,500, which is, yes, about just over 1,000 more than it was last week, which is an incredible sum. But in reality, I'm now buying the same stocks for a worse price. Last week I could have been getting Redrow for a solid £4.80, and now I'd have to buy it for £5.20. I'm effectively paying more for the same companies, which I don't see in a good light. And in fact, personally, whilst yes, it would not be good for very many people, I would have much preferred a bear market that had downtrended for a year or 6 to 12 months and then slowly had risen back up. But instead, we're seeing more of a V-shaped recovery in the stock markets. And a V-shaped recovery isn't necessarily a bad thing, and I think, in fact, this probably benefits a lot more people, because as the furlough scheme ends, which it has been extended to October, but it does obviously drop from 80% wages covered to 60%, that what will happen is that they will get laid off, but at least then they can sell their investments, which at the rate they're going to be at all-time highs, so at least then they've got something there if they have to sell it. But the portfolio has had an increase of about 15.65% over the course of the last 2 weeks, which is quite incredible growth, really. Honestly, it's something I'd expected, just not as quickly. I know that I'd bought undervalued companies with great business models. It's just didn't really think that I would be gaining nearly 1/5 of my portfolio back as returns in about a few weeks, which is quite incredible. And it is really impressive when you think that my portfolio beta volatility is actually less than 1. 1 is the same as the market. So if my stocks in my portfolio are 1, it means they will drop at the same amount in the market and rise at the same amount in the market. I do have a few above that, such as Aviva, Legal & General and Redrow. They obviously have higher volatility, so they will drop further than the market or rally further. And that's where the buying opportunities are present. which I no longer see if you're looking more at short to medium term, but I definitely see if you're looking for long-term purchases. And in fact, this week we've seen some serious gains. Legal in general, over the last few weeks, is actually up 28% overall in my portfolio. I made a video about my June dividend stock to buy for the FTSE 100 in 2020, and if you want to see that, click the card at the top right of the video. But I mentioned that I wanted to buy some of the insurers, and I had a price target of £1.95 to £2. Well, Legal in general is sitting at something like £2.80 at the moment. Skyrocketed in price. Or I think it was £2.50 actually, which is still such a considerable amount, seeing as I would have bought it at a lower price. So we are definitely seeing some gains in terms of the insurers. And we're also seeing gains in terms of Shell. This week alone, they've gained 16%. Although I'm not too optimistic, I don't think that will remain and retain and continue to grow. I do think that they are still undervalued for what they can be, but I do think they are very affected by current politics and economic cycles. So in the long term, I think it's a great hold. It's just, I don't see that one consistently outperforming the rest. But I am, from this, going to take up a point, and that will be improving my cash position. Currently, I'm seeing a lot of my stocks in my portfolio increase by double digits. There are a few exceptions, such as Unilever, Diageo, National Grid, GSK, and Tesco. But those are more staple companies. They don't grow as much, so they just hold their value per se. But the rest of the companies in my portfolio have seen significant growth. And it does feel bad, because you got that feeling where I got them at such a great cost basis that averaging into them doesn't feel as good now. And that is a fair point. And so what I'm deciding is that I'm going to build up my cash position. I've got cash outside of the portfolio, but I'm also going to build up the cash position inside of the portfolio until I see significant discounts or something where I can really get value with. Currently, however, National Grid is dropping quite considerably. And if they do go below £9, I will likely buy more into them, because I don't see them growing by capital growth a lot over the next few years, but I do see them holding their value quite well. And with a dividend yield of around 5%, it does seem like a staple addition to the portfolio just to build up the position. And I've kind of got a hedge in that regard. And as Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. And currently in the market, it doesn't seem that very many people are fearful, at least retail investors, which would be you or I. But these institutions, I'm not really seeing too much additions to their balance sheet. I mean, Berkshire Hathaway haven't added anything at the moment, which is fascinating to see, which could mean that they might perhaps expect another large drop in the market. In that regard, I also agree with it. I think if we have a significant drop, maybe like a 10% drop over the course of a week, that is when people have got stop losses. Those stop loss counters are going to get hit, which is going to lead to more sales, which is going to drop even further, which is going to lead to more stop losses selling off. And this is going to turn into a really vicious cycle that leads to a lot of investors losing money. I don't like stop losses, but I'm not going to go into that. What it does mean is that the market will considerably drop. And at that point, I think there will be a great time to reinvest. And I think if you have most of your money in the stock market right now over your overall assets, then there's no real need to add more in and pile more in. Instead, you should build up the cash position, be ready to take the opportunity if it arises. And that's what I'm going to do. I do see an opportunity for more fair value companies at the moment, because typically you don't really get them at a discount anyway, and a lot of them are trading at least under 10%, such as Unilever. So yes, you could buy into them, and it may pay off for you. And I think you can buy a fair value company now whilst everything is starting to get more overvalued, and you might be able to do well from it. But personally, I'm going to build my cash position and hope for the best. I'm also seeing the capital appreciation, so overall it's doing well. We've also actually received dividend income, and in fact I was expecting more. I think this is on behalf of Freetrade. They typically try to do it as soon as they possibly can, and well, they haven't. I've only received one dividend so far. I was expecting two. One of them was from Unilever, and that's £2.16, which really isn't a lot. It's a quarterly payment. It's about 1/4 of what I would achieve in a year. But that's because my Unilever position isn't as big as I want it to be at the moment. And over the long term, that will increase. But I was also expecting a dividend payment from Legal in general. Whilst yes, I didn't have anywhere near as big of a position when I first earned that dividend, I was still expecting around £18. And Simply Wall Street has said that. But Freetrade still haven't given me the money, which is something interesting to think about. But this does bring me on to the main topic, which is about achieving monthly dividend income, which is truly passive, and then you could live off your dividends in the future. Ideally, my goal for dividends is so that it can take over all of my regular expenses. For most people, that would be pay off their mortgage, that would be pay for their groceries in the month, maybe even pay for a holiday every year or something like that. standard expenses that they would see as regular so that they can enjoy life and live it to the full. I would like it to supplement my primary source of income, which isn't a lot at the moment, but I expect that to grow, and I was hoping that dividends could do that. And actually in the next 10 to 15 years, I'm very much hoping that I'm able to supplement it and have that ability where I'm not locked or tied into any job, because I could just walk out and live off of dividends if I wanted. But I do actually really enjoy working, so that's a very unlikely thing to happen that I would just walk away from something like that. Instead, I would love to continue working and developing my portfolio further. But that's my kind of goal. It depends, when do you want to retire, how much you want to retire, how long you're going to invest for. And so I've taken into account 3 separate salaries when working out how much you would like to live off of dividends. And these are very modest per se. I think there are definitely incomes and ways of earning a lot more money than this, and you, the viewer yourself, might be earning 2, 3, 4 times more income than a lot of these salaries. But I wanted to look at more of a lower end of the spectrum, more average, more entry level, so that you could see that it is truly possible to live off of these style of dividends. Currently, according to Simply Wall Street, my dividend income according to my whole portfolio is 3.2%. I don't think this is based off of cost basage, and this changes with capital appreciation and not. So if I bought in right now into my portfolio, into my positions at this point in the market, I would have a yield of 3.2%. But that's not including Redrow, which I do think would bump it up, and also Aviva, which would significantly bump it up. And at 3.2%, if you wanted to have a starting salary of $16,000 per year, you would need £500,000 invested, which is a lot, I'm sure. But if you're able to just save and put away money for the next 10 to 20 years, you could no doubt easily reach that goal. And don't forget, you're also going to be compounding. Capital growth is going to be happening on your investments, as well as dividend growth. You're going to reinvest those dividends, and slowly but surely it's going to spike up like that, and you will eventually reach it. Yes, you might not reach it in the next 10 years. It does seem very unreasonable. But as a long-term investor, which I believe you all mostly are on this channel, it's certainly achievable. And $16,000 a year is no small sum. I'm pretty sure you could probably go to a third world country, somewhere in Asia, such as Thailand for instance, which I would definitely class as an adult Disneyland. You could go there and you could probably live off of $16,000 a year. You could stay in fairly modest hotels, but even then that might be a quality increase from where you're living in the UK or America. The second salary is $24,000 per year. I'd see this as a more average salary, more entry level. The first one was more minimum wage, where you'd start just from turning 18. This is more, you've done maybe college, university, you've studied. This is where you might jump in a bit more. And this is $24,000 a year. And I think you need £750,000 invested at a dividend yield of 3.2% to achieve that. And that's dividends. That's not even accounting for capital growth of your portfolio. So you could have $750,000 invested, and let's say the market grows by 8% annually each year. Your capital figure is also increasing bit by bit. And sure, you could even do the 4% rule and sell off some of that. So overall, yes, you would have more income, but then your dividends would start to drop as well. I'm sure there is a way of balancing that out, but you are still increasing your overall net worth from doing this. And in fact, to have a salary of $32,000, which I would see is quite high end, at least from my perspective, as I'm very young. I'm not a business professional, for instance. I've not got the skill sets that would get me into higher levels of employment. And in fact, $32,000, you need $1 million invested, which does sound like a lot. I mean, who's just got £1 million lying around? But even if you had premium bonds, there is a very, very small chance that you could just win $1 million like that. I'm not saying go gamble your money or put it in the lottery, but I am saying that there is a chance for this to happen. And with discipline, moderation, you could certainly save up for this and have this as your retirement. I'm sure living off of £32,000 a year, when not having to worry about working, you could probably have multiple holidays a year, have your house paid off, and live honestly quite an enjoyable, relaxed life. You could go move to the countryside, for instance. And this is where typically my dividends, the companies that I have increase their dividend by an annual compound growth of about 5% each year. 2% is the marker that the Bank of England tries to keep for inflation. There's an additional 3% on that, which is considerably higher than that of wage growth. I know for a fact that I'm probably not going to be getting much more than inflation on wage growth, but then I'm at a very basic entry-level job that probably anyone could get into. I also want to move to monthly income, because you do want monthly passive income with your dividends. And in fact, in the UK, unlike the US, there are a lot less quarterly paying dividend stocks. And this is due to different regulations and legislations in place, because it means that they only need to do like reports on their like growth GDP biannually rather than quarterly. So it's just easier for the UK companies to just do it twice a year. Hopefully in the future things change and it will all be quarterly, and then we'll all be rolling in dividends, but at least for the time being that's not the case. So how do you achieve monthly dividend income? Well, you either own a lot of stocks so that you have payments at all the times, but truly you want to have a smaller amount of stocks in your portfolio, and that accords to your risk tolerance. I'd aim for around 15 to 25. And this does mean that there might be some months that are getting a considerable amount of payments more than the others. And in fact, if I looked at my notes, I am actually getting a lot of payments in March, April and June and August. Like I get a considerable like 5 payments in each of those months, and then the other months are like 1 or 2, so it's not very balanced. And even some of my months, such as February and May, I don't get any payments currently. That is partially due to removing Britvic, as they did pay in February. It does mean that I will need more companies to pay into that, or more quarterly payments. So how do you do this? Well, there's one option here, and that is budgeting. You could say that you could get 1 dividend payment per year, which is £12,000. You could then divide that by the amount of months, which is 12, and you'd have £1,000 to budget each month. That's an example. Or perhaps you've got a quarterly dividend payment, so each quarterly dividend payment you divide by 3. You might be getting £100 every quarter. Divide that by 3 and you've got £33 each month. But that might not work for those that aren't as good at budgeting or are worried that they'll spend it immediately. Another thing to do is create a spreadsheet. I've personally written it down because I didn't want to have it in a spreadsheet, because I much prefer to write things down in this regard. If it's very numerical data where I'm tracking dividends, for instance, I would much prefer a spreadsheet. But I want to write it down. I write down my investments. Sometimes when I can't sleep, it's about 5 in the morning, been lying in bed for about 4 hours, I'll think suddenly, right, what if I have this investment? And then I'd start writing it down in my notepad. And yet I am missing 2 months, so I need to start looking for stocks that do that. And in fact, whilst I'm on this topic, I've currently created a video series that details 5 great dividend companies to own that pay in each month. And I've started with May, so if you'd like to see that, click the card at the top right of the video. But the second option you have is actually writing down all of the dividend payment dates of all of the companies in your portfolio and seeing and just tallying by each month and seeing, right, okay, I've got 2 payments in May, but 0 in August. Perhaps I could sell out of one of my stocks and then buy into another, but you also want to make sure you're looking at companies with great fundamentals. And so typically, I wouldn't sell out of some great companies just because they pay in an uneven balance, but rather I would just look for other companies to add. Perhaps you want investment trusts, for instance, as they might actually help you out more. An example I would have is, because I'm missing dividend income in February and May, I could get a quarterly dividend payer which covers both of those months and then boosts my other months too. And things like Greencoat UK Wind would solve that solution for me very well. It's an investment trust on energy, renewable energy, which is probably like a sector that might benefit in the coming years, and then I'd have consistent dividend income. And in fact, this is perhaps what I might do. If I think Shell gets overvalued, I'm going to sell out partially of Shell and put it into the renewable energy sources. So I think it's all about looking for your goals. How long do you want to invest for? How much money do you want to live off of? What are your plans for the future? Do you want to be an expat and go move abroad and just go like travel the world or something? Or do you want to just make sure you've got your house, your mortgage, and live pretty free, live in the countryside and be relaxed and spend time with the family? It ultimately depends on you and your goals. For some, I can imagine they'd like to retire a modest 10 to 15 years earlier than the general population, and they'd like to pay off their mortgage, have money so they can go on 3 or 4 holidays a year, be able to buy their family Christmas presents as such, and that probably would be great for them. However, for someone like me, I want to retire, well, not retire, but be financially independent as soon as possible. So I want to maximize the gain from my investments. And so I want to have as much dividends as possible to compound the overall growth of my portfolio, and also look to increase my overall income in the short to medium term future, so that can scale up too. And as I'm changing up the format of my portfolio updates, I'd also like to answer a question that I've seen in the comments down below. So here's the question. Hey Osborne, loving the channel, really insightful content. I've been building up a dividend portfolio on Freetrade for the last year or so. Wondering what your thoughts are on when I should start moving it into a Freetrade ISA and what the most efficient way of doing it may be. Thank you for the great work you put in, Ben. Firstly, thank you Ben for the kind words. It does mean a lot, and it does mean that I'm able to give back to the community as much as I can. In regards to your question, I think that it really depends on your goals, like I've mentioned before. If you're considering growing a serious amount of wealth in investments in the future, then you should definitely look to start putting it in an ISA. I don't know how much you currently have, but I know that you are exempt from some things such as the dividend tax allowance of, I believe, I can't remember, it was either 1,000 or 2,000 per year, which means that you could have up to a certain amount of dividends. And if we go by about 3.2, roughly, you could have about 15,000 before that's more of an issue. But I personally would start putting into it now. If you've currently got investments in the basic account, I don't think Freetrade really offer a way of transferring that over. So what you'll want to do is, or at least what I would do, is start adding new investments into the ISA and start building on them from there. Average into those positions, because you could sell out of one and buy into the other, but then there's a lot of risk between traders. And there's a lot of trading going on in the UK markets, and there is a chance that you could literally lose out on money, one due to stamp duty and two due to traders just influxing the prices. And with such high volatility at the moment, that could lead to a lot of risk. And so I would certainly just start dripping your way into the ISA. However, in the meantime, whilst you're just slowly building up that ISA, I believe the Financial Conduct Authority are working on a way of transferring investments between brokers. So this could mean that you should be able to transfer your shares that you own to different brokers. And by regards to that, surely Freetrade would be able to transfer from their basic account to their ISA. If not, perhaps there's a way of transferring your investments from a basic account with Freetrade to an ISA with Trading 212, and then transfer from the ISA with Trading 212 to the ISA with Freetrade. It's a very convoluted, long path to take, but that would be a method in future that could work. And it really depends on what your goals are in your portfolio. If you plan on holding over, I plan in the next 10 to 15 years, so about 200,000 in that portfolio and get as much as possible as I can out of it. And so taxes would really severely impact the overall growth of my portfolio. So for me, it's a no-brainer. I need an ISA. But if you don't plan on investing for too long, and in fact, in the next 2 years, you might be thinking, right, I want to take this money out, put it in for a house as a deposit, and that will be my current investment, and I'll build up equity in the house, then perhaps ISAs aren't for you. Though I definitely believe you should make the most out of them and get the most out of the tax exemptness that you can get from putting into them. After all, it's like what the US have, which is a Roth IRA, except they can't touch it for retirement, but it's also tax-free. They can only put $6,000 in a year. We have stocks and shares ISAs that we can put £20,000 in. So we should really make the most of this. And in the future, we would likely outperform that of our US friends across the water. And that brings this portfolio update to an end. I'd like to thank you all for watching. I'm Osborne Foreman. Have a great day.